All right, let's talk about something absolutely crucial for anyone in the crypto space, trading. Today, we're going to break down the 10 most common and most expensive pitfalls that traders fall into. But more importantly, we're going to show you how to turn those traps into a winning plan. You can think of crypto trading like a high wire act. It really is. On one side, you've got the potential for these incredible financial rewards. But on the other, well, it's a very steep fall. The thrill is absolutely there, but success? That requires balance, discipline, and knowing exactly where not to put your feet. So that's what we're going to do here. We'll use these common mistakes as our roadmap. By really understanding these pitfalls, you can start to build a strategy to navigate the market with way more confidence and, keep your balance on that wire. Okay, so let's dive into part one, the psychology traps. Because look, before you even glance at a chart or think about a strategy, the very first market you have to get a handle on is the one right between your ears, your own mind. And we have to start with the big one. FOMO, the fear of missing out. And trust me, this isn't just some casual worry, it is a powerful emotional trigger. You see a coin's price just shooting for the moon, you hear stories about people making fortunes overnight, and this panic sets in, pushing you to buy high just because you're terrified of being left behind. Does that little voice sound familiar? Yeah, that's FOMO talking. It's a voice that just completely silences rational thought. It's not analysis, it's not research, it's a pure gut-level reaction to market hype. And it is incredibly dangerous for your portfolio. And this chart, it just lays it all out, doesn't it? When you make a FOMO-driven trade, your emotions are at the controls. Logic, research, they're shoved into the back seat, making up just a tiny little piece of the decision. And that kind of imbalance is almost always a recipe for buying at the absolute peak. But FOMO isn't the only ghost in the machine. There are other mental traps, too. You've got FUD, that's fear, uncertainty, and doubt, which can trick you into panic selling right at the bottom based on nothing more than rumors. And then there's revenge trading. That's when you take a loss and try to get even with the market by making wild, reckless trades, which, let's be honest, usually just digs you into a much deeper hole. So what's the fix? It's all about a total mindset shift. The goal is to go from being an emotional reactor to a disciplined operator. So instead of chasing trends, you follow a plan you've already made. Instead of panic selling, you trust the research you did. And this is a big one. You accept that small losses are just a part of the game, not something you need to get revenge for. All right, so you've got your head in the right place. Now what's? That brings us to part two, the strategy gaps. Because a strong mindset is pretty useless without a solid plan. You've heard the saying, right? Failing to plan is planning to fail. It's a cliche for a reason. And the absolute foundation of any decent strategy is something you hear all the time. DYOR. Do your own research. This is a mantra in the crypto world, and for good reason. It means actually digging into a project's white paper, understanding what it's trying to do, checking out the team. Not just, buying a coin because some celebrity tweeted about it. The biggest holes in people's strategies are almost always the same few things. First, just having no trading plan at all. No clear rules for when to buy, when to sell, or when to take some profits off the table. Second, totally skipping the research part. And third, really bad diversification, basically going all in on one super speculative coin, which just sends your risk through the roof. This really puts it in black and white, doesn't it? On one side, you're basically gambling. You're driven by good feelings, you're following the crowd, making these all-or-nothing bets. On the other side, you're treating like it's a business. Your moves are guided by rules, by your own analysis, and by a portfolio that's actually built to manage risk. So the question is, which side do you want to be on? Okay, this brings us to our last big piece of the puzzle. Part 3, the execution errors. See, you can have the perfect mindset and the most brilliant plan, but you can still totally fumble the ball when it's time to actually make a move. These are those costly mistakes that happen right in the heat of the moment. So what's the key to good execution? It all comes down to risk management. And that sounds complicated, but it's simple. It just means knowing exactly how much you're willing to lose on a trade before you even get into it, and then using tools to make sure you stick to that decision. The most important tools here are stop losses, which automatically sell for you if the price drops, and of course, proper position sizing. So, what do these fumbles actually look like in the wild? Well, ignoring basic security is a huge one. Getting your crypto stolen is pretty much the ultimate loss, right? Trading without a stop loss, that's like driving a race car without a seatbelt. Then there's getting glued to the 1-minute charts, which just causes you to overreact to every little bit of meaningless noise. And finally, overtrading, just jumping in and out of positions all day, racking up fees, and acting on impulse instead of real signals. All right, let's pull all of this together. We've talked psychology, we've talked strategy, and we've talked execution. But let's not end on what can go wrong. Let's flip this around and turn it all into a proactive checklist that you can use to become a smarter, more disciplined trader. Here it is, your simple 3-step plan. Number 1, master your mindset. You have to acknowledge and control those emotional triggers like FOMO and FUD. Number 2, fortify your strategy. Build a real trading plan based on your own research, and then have the discipline to actually stick to it. And number 3, perfect your execution. Use those risk management tools like stop losses, and always practice good security. And that really brings us to the final question, the one you have to ask yourself. When you look at everything we've covered, the psychology, the strategy, the execution, which one of these pitfalls is your biggest personal blind spot? Because being honest with yourself about that, well, that's the first real step to fixing it. Thanks for tuning in.